All right, so let's just kind of start from the top, right? So KPIs, just in general, they're key performance indicators. Basically, what that means for us, it's the one thing that we can focus on that tells us about our performance. That's pretty much it. Today, we're going to be talking about financial KPIs very specifically. Now, when we look at financial KPIs, they're actually broken down into different categories, right? We have our profitability KPIs, all right? We have our liquidity KPIs. We have our solvency KPIs. A few other ways that we can kind of look at this as far as different styles of KPIs. Then we have, when we look at all of that, we also have our leverage, our debt KPIs, and things of that nature. But we're going to break it down between profitability, liquidity, and solvency. For most of us, all we really care about is profitability. How profitable can we be, right? How much money can we keep? Again, we can go out there and make 13 million, but if we're not keeping anything, what does that really mean for us? Typically, we do that through our gross profit margin, our net profit margin, and something called an EBITDA margin, all right, or operating income margin, all right? So let's focus on those. So when we look at that, let's think of a real estate, right? We're all in real estate. So if we wanted to do a flip, well, we got to purchase it, we got to renovate it, we got our holding costs. All of those things are required in order for us to then sell that property. So that's cost of goods sold. So when we look at gross profit margin, we're saying, hey, how efficient are we at creating our top line revenue from the product that we make? How efficient are we in making a product that makes profitability? All right. So let's think about this. When we do something like this, on average, we'd like to see our gross profit about 80% or higher of our total income, which means that it only took 20% our cost associated with building out this property or building out this flip or building out whatever it is was only 20% of the total revenue that we generated. All right. So let's put it in different words. Hey, if I can purchase a property for $10,000, I can renovate it for $10,000. I'm all in $20,000 now. Ideally, I would like to be able to sell it for $100,000. Does that make sense? Now, let me ask you guys, for those who've done flips before, do you think that's actually a reasonable number? Yeah, right? It's probably not. It's probably not. During flips, we're most likely putting in what? 70,000, maybe 75,000 and selling it for 100,000, right? Give or take like 75 cents, 70 cents to the dollar. Some of us are getting great deals, 50 cents to a dollar. Yeah, for sure. Well, let's be honest. I mean, hell, even if you guys remember the max allowable offer formula, right? It's 70% of ARV minus repairs is the max that you can offer, right? If you guys have heard of that one before, right? So even when we think about that, okay, great. If we have a flipping company, then our gross profit margin is probably going to be somewhere around 30%. Does that make sense? Because 70% went to the purchase and the renovation. So we good on that? All right. So how do we actually use this? So when we compare this gross profit margin, his gross profit margin is 20%. That means, I'm saying 20 even though it says 22. But what that means is 80% of all of the money that he earned went into making the product. So he's only left with 20%. This means out of that 20%, he still has to pay all of his bills, all of his software, pay his salary, pay whatever before there's a net profit. Now, the reason I'm highlighting this here is because, as we said, if flipping is our primary thing, or manufacturing really is what it is if we're manufacturing, redeveloping, doing anything where we have this product that we have to buy the supplies, we got to put in all the work, we got to do it, we may see a slightly lower gross profit margin. But most of us are in real estate sales of some sort, or wholesaling, or something, assignment of a contract, novations, all these other things, when in reality, we shouldn't have any expenses. So therefore, we should see a gross profit margin of 80%-ish, right? Between 70 to 85% will be a really sweet spot. Anything higher would be better. And oftentimes, we'll see wholesale companies with really high. So this guy right here, he has a 22% gross profit margin, but His entire business model is wholesaling. So now, because we're looking at the financial KPI of a gross profit and we know his business model, are you guys starting to see that there might be a problem here? He's got no cost to goods sold. Yeah, go ahead, John. Something isn't going right? Because remember, gross profit is before we even spend the money on our bills, our software, our whatever. So he's dumping all this money in to try to wholesale. And let's think about it. What costs are associated with wholesaling? When we talk about flipping, right? We got renovation, we got to purchase the property, we got to do all that. With wholesaling, what costs are there associated with it? Exactamente. So for this one here, if wholesaling is so low cost, how do they get in the 20% profit margin? After we dug in here, what ended up happening was they were doing double closings. All right, and so a double closing means they actually closed on the property. They paid for it in full and then turned around maybe a week later and then sold it and collected the difference. But when you do pay for a property, since that money has left the bank account, it will reflect here. All right, it will reflect in your financial report. So that's what ended up happening. But that was a big red flag. We knew immediately where to look because this wasn't right. Okay. So we looked at that for gross profit margin. Does everybody feel semi-comfortable, lukewarm on gross profit? How we kind of analyze it, right? We basically look to see what's our business model. Does it make sense that it should cost this much to create income? All right. If it doesn't, let's figure out why. If it does, cool. We're somewhere in that 70, 75, 80% range. That's where we'd like to be. Before we go into this, we're then going to go to net profit margin. And John, you hit the nail on the head. The net profit is basically top line versus bottom line. After all the money that we brought in, how much did we actually retain at the end of the day? What's that comparison? We want to figure out what happened between gross profit margin and net profit margin. So right here, we had 20% to play with, yet he lost 5%, meaning he came in at a -5. I'm just saying -5. I'm rounding up here. So basically, he lost 25% between there. So now we got to go back and look at the profit margin and see what happened. But when we look at the profit margin, now we're looking at marketing. Now we're looking at wages and salaries. Now we're looking at some of those expensive things. The question always that we're asking consistently is where did the money go? Where did the money go, and does it make sense that it went there? Did we spend too much? Did we spend too little? Did we invest it correctly? He had 37 left, right? His gross profit. That's how much he had to spend in his company. We call that real revenue. That's the real money he had to spend, yet he spent $44,000. So where did it go? Well, as soon as we start going up through these different expenses, boom, we see a big one, $20,000. Boom, we see another big one, $11,000. Now, we've talked about this before. Typically, in every company, there's two major expenses. The ones that are typically the highest. It's your advertising and marketing, and then it's also going to be your employees or your wages, right? Same thing here. Same thing. Really high. All right, then we come down, we see some other twos, ones, boom, payroll, right? So now we have to ask ourselves, hold on, we have payroll here and we have contractors here. What's the difference? This guy here has 6,400 in payroll, and then he has another 11,000 in contractors. All right, why are they separate? Does anybody know why you might see payroll versus contractors on a P&L? Contractors, typically, it's perfectly fine to see that. They're typically your 1099, your virtual assistants, your something of that nature. Whereas your employees, they're going to be W-2, right? They're going to come on, they're going to be W-2. For sure. So this is a profit and loss statement, just to be clear. It's not a balance statement. And as we kind of continue to go through there, it's always important to just understand which one you're on so it starts to make sense. So for profit and loss, the reason why it's so important is because with contractors, with a 1099, we are just paying a flat fee to the contractor, and that contractor is responsible for paying their own taxes. All right. When we have W-2 employees, we are also responsible for paying payroll tax, which essentially is half of the employee's taxes as well. So we want to separate that to understand how much is coming from which. So we'll go through here. We see that hell, just between advertising, contractors, and payroll, we've already spent the full 37 that we had to spend. Okay, everything else was extra. So now that you guys have came in, you guys look, you're looking at your finances, you're like, all right, my gross profit, it's decent. My net profit, starting to shake. And you open these up. If this was your financial statement right here, where would you want to look at first in the expenses? And what would you be looking for? So now it's like, hey man, I need to see all of your marketing, right? What do we mean by marketing? I mean, I want to see how much you're spending. I want to see your conversion rates. I want to see all that, right? So you hit the nail on the head. We want to see where's the money going. Obviously, the way I like to look at it is where's the most money going? Because if we can improve that spot by a couple percentages, it's going to have much more of an impact when we focus on the small one and improving by a couple percent. So what does that look like? That's our operating expense ratio. All right, our operating expense ratio is basically saying, hey, how much of our money is being spent in expenses? Right? How much is being spent in expenses? So inside of QuickBooks, if you guys have that, you guys can actually do a profit and loss as a percentage of total income. Same thing that we just saw on that other sheet, right? On that other financial report. Is gross profit 22%. All right, then we come down here and we start to see, where did the advertising go? Advertising was 12%. Contractors was 7%. Payroll 4%, right? Total expenses, $26,000. So look here. We got all the percentages by category. So the reason how you just did that, John, basically what you did was you said, all right, if we're spending $44,000 or 26%, half of what we're spending basically is going to advertising. Right? This is just a cleaner way so you have the numbers laid out in front of you so you know for a fact, no shit, half of it's going to advertising. Let's dig here. So the next thing with that is, once we know what we're looking for, we got to have the right tools. Now, you guys have access to this. All right. It was in the course, but I just want to paint the whole picture as we kind of go through this. So now that we know that one expense, the marketing expense is the thing that we want to focus on, you guys have this marketing KPI tracker. So this is where you would come in and you would put, how much money did I spend on my website? How much money did I spend for networking? How much money did I do? How many leads came in from that? How many deals did I close this specific month? All this blue calculates itself. What was my revenue from the closing this month? All of this will calculate itself. All right. You do this and you do it for each month, and then it all joins together in the front. Now, again, I got to redo his because there's some technical issues on his, the formulas he messed with. So I got to come back to that. But when we look at this, guys, we have our target return ratio. We got our return on investment. It makes it a lot easier for us to say, yo, we spent $20K this month on this. Where did the money go? And which ones actually worked? So next month or the next quarter, we could say, hell no, we're not spending the money on the ones that underperformed, right? Negative 100%, if you guys can see that. Right? If you look at ROI, these were negative 100%. Well, we're not doing that next quarter. This one, we got a 600% return. Hell yeah. We're definitely doing this one next quarter. Right? So I just wanted to paint that picture a little more there. So just like you said, John, you go in there, you highlight it, but then you have to evaluate it. Right? You guys have the tools already to evaluate a majority of these. All right. So any questions on, these were all profitability metrics here. We have gross profit margin, operating expense ratio, and then net profit margin. Any questions on those? All right. So now we're going to move to liquidity. All right. Now, liquidity is basically saying this. How much money do we have, and what is our ability to pay any upcoming debts? That's it. That's really what it means. All right. So when we think liquidity, we got to think like this. Money is coming at us one way or, I'm sorry. Debt is coming due at any given time. How much do we have to pay off anything that's upcoming? And there's two primary ratios here. We have the current ratio and the quick ratio. All right. Current ratio is real simple. We're going to take our current liabilities and we're going to divide it by our current assets. And we're going to see, do we have enough current assets to actually cover the debt that's coming up, right? And so there's actually total current assets divided by total current liabilities. I just switched those up a little bit, but same. So because it's assets divided by liabilities, the higher this number, the better. All right. Typically, people will say, you guys remember the debt service coverage ratio number? What's that magic number? Does anybody remember? Yeah, it's like 1.2. 1.4 would be like ideal, right? But a 1.2 or a 1.25 is typically considered, bare minimum. And you could almost say the same for your current ratio. All right. A 1.2 to a 1.5 is a good place to be. Obviously, the higher, the better. However, if you're below 1, that means you have more debt coming up due than you have the ability to pay it off. Does that make sense? So if you got 10,000 coming up and you only got 5,000 in the bank, you have more debt coming up than you do have to have the ability to pay it off. If it's 10,000 and 10,000, then that ratio would be 1. And at least you have enough. So that's current ratio. All right. The only difference between current and quick ratio is that quick ratio subtracts inventory. Most of us aren't going to really have inventory to sell like that, right? Let's talk about real estate agents. As a real estate agent, yeah, you're selling houses for others, but it's not your inventory. You don't own it, right? We might say it's inventory, but it's not our company's inventory. Wholesaling, there really is no inventory. We have the contract. We're ready to assign it. Any service-based, professional service-based, typically there's no real inventory. Companies that could have inventory or investment strategies that would be flipping. Because as you own the property and you're renovating it, that's inventory. So we could look at that. If you had a construction company and you actually purchased a ton of material that you just held in bulk, that could be one. A plumbing company, same thing, so forth and so on, right? So there's certain companies that might have inventory. Again, when we're looking at quick ratio, it's how quickly it can be done, right? And so the inventory, even that inventory has to be something that can be liquidated within 12 months that we're subtracting out. That's not the definition, but that is the perceived definition, is that it has to be 12 months or less. Because if it's not, then it's not considered liquid, right? So real estate, in theory, is not considered a liquid asset. Now, we all know we might be able to sell it in a couple of months, but for accounting purposes, it's not considered a liquid asset. When it's so-called quote-unquote liquid, it's when it's placed in inventory, and even that is a debate amongst accountants, because some will say it could be inventory and we can place it in a long-term asset. We don't necessarily need to place it into a current asset. So, but ultimately, liquidity is like your cash or cash equivalent. Stocks might be bonds that are coming due in the next 12 months, because you could have like a 10-year bond or something like that. It's not necessarily current, but again, all really depends on the accounting method and preference. Okay. Next is solvency. Now, this is kind of more of that second part to your question, John. Solvency says, all right, if I were to sell all of my assets, long-term or current, can I pay off all of the equity and walk away with something a little extra? All right. So this is a debt to equity ratio here. Basically, how much debt is compared to the equity, right? So come down here. It's your total current liabilities plus total long-term liabilities divided by total equity. And so the concept is that we can look at all of these liabilities and figure out how much equity that we have in there. The debt to equity ratio represents an entity's financial leverage. The ratio is a measure of the degree to which an entity is financing its operations through debt versus wholly owned funds, right? Basically, your skin in the game, your contributions as an owner. The lower the ratio reflects the ability of the shareholders' equity to cover all outstanding debts. Now, for us, most of the time we're like, yo, if I can get a loan, let's get a loan, right? But we have to think about that too. If we don't have a lot of skin in the game, if I don't have basically any skin in the game, I'm all leveraged, no equity. And then I go to you, John, I say, John, man, hey, look, I need about $500,000 from you for the company. Company's doing good, man, da, 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 da. But then you look and you see I have no skin in the game. What's your inclination? Are you concerned? Are you a little bit like, what's your thoughts? There you go. Yeah, you're going to take extra precaution. All right, I'll give you a loan, but let's collateralize everything. Everything. Not quite. To your point, though, equity can be considered the net worth portion to an extent. And oftentimes, many people will, when they're doing their personal financial statement, they'll take the equity portion of the company as their company's net worth, right? So it's basically the assets minus the liabilities, just like we would do on a personal financial statement. It's the same concept within the company. But so just to kind of separate that, because debt to equity is a measure of how effective could we be at paying off the debt. That's debt to equity. All right, debt to assets is a measure to say how effective, if we sold all of our assets, could we then cover all of our debt, right? So equity is our contribution. Do we have the ability to cover our debt? Debt to assets is do our assets have the ability to cover the debt, right? So those are two ratios specifically revolving around solvency, which is the ability to sell stuff to break even, to basically break even. That's the measure that we're doing. Those play a huge effect, are a huge impact here, because if we do have a high equity, debt to equity, or I'm sorry, a lower debt to equity, it'd be a lower debt to equity, and a lower debt to assets, then that actually means our net worth will be, our company's net worth would technically be higher because we have more assets and we have more equity, if that makes sense. So there is a correlation, but it's not direct like it's to the way and manner that you just mentioned. Nothing so far. Okay, so what I'm going to do now is I'm going to pull up, before we go into anything else, we're going to look at somebody else's financial statement, and we're going to go through all of these. Okay, so if you guys have a pen or something, or you guys been taking notes, we want to look at gross profit margin. We want to look at net profit margin. We want to identify the highest expense. All right. Then we want to do our current ratio. All right, that's current assets divided by current liabilities. All right, and then we want to look at our debt to equity and or debt to assets. All right, those are the ones we're looking for. So when I pull up this report, we're going to go through it piece by piece, okay? So net other income is, great question. So net operating income, this is saying this is how the company has performed. This is how the company has performed this year. When we look at anything below net operating income, we're typically going to be adding in things that are not necessarily specific to the performance of the company. So you may see depreciation added in here sometimes, or amortization, right? Because it wasn't really the performance, but it's a tax incentive. You'll also see things like mileage reimbursement for the owner, right? Maybe if it's not really driven for if the employees need it, that's a company expense. But if the owner's doing it, maybe we can move that out the way, right? Because the lender isn't one-on-one. I mean, if somebody bought it, they're going to take that out anyway. Okay. All right, cool. So improvements are improvements. Just like you said, purchase price is the price that we pay for the properties, right? So to your point, man, kind of things are just kind of what they are. But if we see historically that 90%, 90 cents of every single fucking dollar that we earn is being blown away out of here. And of that, I can't do the math this fast. Hold on now, 60 plus 75, almost 80% of it is going to these two categories. Exactly. We're flipping for the sake of flipping. What's happening is oftentimes when we get into this role, right, when we're starting to do multiple deals, I don't care if you're an agent doing multiple deals, if you're an investor doing multiple deals, we start looking at just what the deal can produce. Holy hell, I can make $20,000 off this deal or $50,000. right? But then they don't realize that you had to spend $700,000 to make the $50,000, and it's not worth it anymore. So what we can focus on, different things that we can think of is, hey, look, we don't have deals, so how do we fix this? Well, how about we look at how we are evaluating deals? Let's go back and look at all the deals that we've done. Which ones were the good ones? What went right? Which ones were the bad ones and what went wrong? Now, let's create a standard about how we go and purchase everything else in the future using the data that we already have. All right, that's an example. All right, improvements. Bro, improvements are improvements, but seriously, how can we tighten this up? Well, one, how we buy and how we evaluate budget, that's one thing that we can work on. But also, what does it look like if we buy all the material? What happens if we have, like some of you may already be familiar with this when you do your own flipping, right? But you may have a specific countertop, specific cabinet, specific paint color already laid out. So now you know, hey, it's a 3-bedroom, this many square foot. I know to order, and the price is already locked in. I already know what it is, right? And so there's so many different things that now are revolving around systems and processes. So now you guys can start to see everything that we've been doing up to this point is learning just how to read fucking financial statements. But now the rubber meets the road. Once we understand what the hell we're looking at, once we understand how to really start to peel back the layers, it's telling us what's wrong with our business. It's screaming at us like, holy shit, we're not actually getting deals. Let's go back and reevaluate this whole thing from the top. It could even be, you talked about switching asset classes. It could be that really gut-wrenching conversation of maybe our business model is fucked up. Maybe we shouldn't be flipping. Maybe you know what I mean? But I mean, we have to have these conversations because a lot of times we think we're so good at something, and in reality, we're losing money. Now, this guy here, look at this. Look at how much money he made. Year to date. Last year, it was a lot more. Out of all of that, yeah, it makes you feel good because you see all that money. Out of all of that, this was his operating income. But at the end of the day, do you want to put in all this work for this amount? Just to walk away with that amount? We can get a job for this shit. You know what I mean? Like, we get a job for that. Why the hell are we going to do all of this? What I showed you was from month to month, in fact. So really, in reality, last year is actually fairly similar, just with larger numbers. Oh, no, all I meant was last year they made a lot more, but the percentages were actually very similar, right? And so that's, no, but that's a great point, though, because, again, we can sit back and be like, yo, I made 25 million. I made 30 million. All of that is vanity numbers. Because as business owners, we need to know how much did we keep. Does that make sense? So it's like, all right, cool. All this vanity stuff, great. But how much did we keep? And so now that you guys are seeing this, and I know, Dan, you've seen this all the time already, just with other people and their personal income. But when somebody comes up and they said, I made $30 million last year, it's like, cool. But don't take that like, holy hell, these guys are killing it. Because they may have made it, but they may have kept none of it. All right. So real quick here, we're not going to spend a lot of time on it. All right. But I want to show you guys where you find the current ratio at, right? And debt to equity. So current ratio, guys, is going to be right here. It's going to do your current assets divided by your current liabilities. All right. And so if we look at that, in theory, we got a really good current asset to current liability ratio, right? This is saying this is in the negatives and that's in the positives. The reason that's wrong is because inside QuickBooks, specifically, this is so sophisticated that very seldom should you actually see anything negative. So what that means is they inputted these incorrectly, and these are no longer liabilities. These are actually benefiting, meaning that they should be an asset if they're negative, right? We're not going to dive too deep into that right now. But so that's where you would get it, current assets versus current liabilities. And then the debt would be your total liabilities here. Or I'm sorry, the debt to equity, right? Total current liability, excuse me, guys. I'm sorry. I'm trying to rush here at the end. Total liabilities divided by the overall equity. And you can see that that is not a good ratio there. Almost 8 times more debt than there is equity. Okay. So with all of that being said, as we're polishing up here, seeing how much income these individuals made, do you believe? What's your thought? Put it in the chat or just come off of mute. Is this a healthy company or not? So there's successful components of the company, but overall, the company is not financially healthy. Let's put it that way. And the best takeaway of this, guys, is as you really start to understand these finances, how to break it down and how to read it, it tells you where you're lacking in your company, which is the most important takeaway from it all.